Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. This video I'm going to do a mini challenge slash analysis slash see what happens on my TNA position. I'm doing this video on Wednesday on May the 12th, but this position may or may not actually occur where I said for the dates and numbers. If it does get assigned, I do have a cash put at 85, and right now it's in the 84s as I make this video. If it does get assigned, I'm going to look at three different options. I'll be following one of the three options and give updates on what happens with it. If you're interested in following it, I did make a playlist for TNA, and I'll leave the link down in the description below. Please like, subscribe, smash, all that good stuff. Definitely helps out the channel. I do want to give a quick thanks to all the new subscribers. We're over 2,500 subs right now. So appreciate all the support and keep on sharing and provide this information to others. And hopefully I can help out as many as I can. Let's get right to it. All right, everybody. So this is what I've been considering with my TNA position. I do have a cash put at 85 that expires on Friday. And I initially made that position because it received $85 in premium. So that's a 1% return in premium for the week. The ETF has been dropping pretty heavily last few days. It's already in the money, a little below 85 as I make this video on Wednesday. So if the position ends up below 85, I will be assigned 100 shares of TNA. And these are the three possibilities that I'm considering. We're going to be following all three of these with the actual numbers in the future whenever it does become assigned. If it doesn't become assigned this week, then we'll follow whenever it actually does become assigned. Here's the starting conditions. I'm going to look for a cash put at 1% a week in premium. So again, for the 85 strike, it paid $85 for the week. That's why I chose that particular strike. And the ETF was in the low 90s when I actually made that position. When assigned, here are the three possibilities in nice, beautiful colors. One of them is to sell the covered call at the same strike of 85, no matter where I get assigned. So let's say the stock goes to 84.50 or so. The covered call premium at 85 for the next week will pay over 1% in the week. We'll look at the numbers after this part. You do get the most initial premium usually, especially if you're really close to the strike price. As you'll see in the numbers, the stock could go down around 81 or so before you're not quite getting 1% anymore. So there's a very good chance that my initial premium will be over 1% on the covered call side. I will get back to the original price. So I'm selling my cash put at 85, selling the covered call back at 85. I didn't lose anything in the share price. I won't lose anything in capital gains because, again, 85 to 85 is the same amount. So in a way, that's a pro. It also could be considered a con, however, because one of the cons is I won't get any capital gains. If I decide to sell my covered call at, say, 90, I'll get the difference between 90 and 85, or $5 times 100 share, or $500 gain in cap gains. But since I'm selling the covered call right at 85, there'll be no cap gains. The premiums could end up being very low, especially if the ETF drops. Again, if we're near 83, 84, premiums are really good. But if the ETF tanks to the 50s and 60s, those premiums will be very low, most likely not even 1% a week. Most definitely, actually, at that point. I think it was around the mid-70s where you'd get close to around 1%. It is a pretty static position. In a way, it's a pro because it's easy to manage. Just sell the cover call at 85 every week, but it's static. I'm just letting it do its thing at 85. The ETF can shoot past the strike price. Let's say that I sell the cover call at 85, the stock goes to 95. I'm not getting any of that gain. And there is a variable premium. I'm not going to be receiving 1% every week. Some weeks I might receive 2 to 3%. Some weeks I might get 0.2 or 0.3%. So that's one simple strategy to go with. Just simply sell your covered call at the exact same price that I sold the cash put. Another strategy I'm considering in red is to sell a covered call at whatever strike will earn 1% a week on the upside. So let's say the stock goes to 83. The 85 covered call for the next week will most likely be more than 1%. So I could go higher than the 85, and then I might get some capital gains there, especially in the first week or two, most likely, especially if the ETF is pretty close to that price. You could get a good long-term return because you're getting your 1% a week. Hopefully, or eventually, you'll probably get assigned at your covered call, so you have to keep those 1% premiums each week. It does move with the ETF in a way that's a pro. If the stock tanks and goes down to the 70s, I can still sell a covered call around 75, 76, get my 1% in the week, and it's a more of a dynamic position. I'm moving along with the price of the ETF. I will get a consistent premium of 1% a week based on whatever the number is. If the strike's at 70, I might have to sell a 74 covered call, but I'll still be receiving the exact same amount each week. Some of the losses are not pros, but cons. Sorry. You might get the cap loss if the ETF drops. So let's say the stock goes down to the 60s, and I try to get that 1% covered call, let's say 65 or so, and then I actually get assigned. That could be a pretty significant capital loss, not capital gain. The ETF could shoot past the strike in the other direction as well, and you wouldn't be receiving the net gain on that covered call. So let's say I'm doing the 1%, goes down to 60, sell a covered call 65. Let's say it goes up to 75 that 1 week. I'll still be locking in the cap loss, and I won't be getting that extra gain. A third possible one, a little static like the first one in blue, is just sell a covered call at 0.3 delta. 0.3 is a very common number that people work with when they're starting the wheel strategy. TNA's IV is in the 50s to around 90% range. So the wheel at 0.3 is a pretty common strategy that a lot of people work with. It's still a dynamic position. I'm going to be moving along with the price of the shares. Some of the cons, though, it is a variable premium. I don't know exactly what the premium will be from week to week. It depends on where the stock is, depends what the IV is. And you might get assigned more often. You're going to be assigned about 30% of the time on these compared to these. Now, these deltas could be ending up near 0.3 as well. When I first started my cash secured put, the delta was around 0.2, so get the 1% a week. So there's a chance that some of these in the 0.3 delta could be very similar to one of the other. All right, so let's look at the actual TNA position. Right now I'm doing this video on Wednesday, May 12th, 2021. Yeah, think about the year there. As you can see, I made a position at $85. I received $84 in premium. That was the 85 minus the 65 cents commission. So very, very close to 1%. I initially made that position when it was in the low 90s. Right now, the stock is at 84 and change. So it went in the money and it dropped pretty heavily. Here's the chart for TNA from May the 4th to May 12th. So you see it had a pretty high support in the low 90s. It went up to 94s and went down to around 92. And then May the 12th, so around May 8th in the 92 area, I actually sold on the red line a cash secured put at the 1%. And then dropped very heavily on the 10th, continued to drop pretty heavily on the 11th. A little worried yesterday because it was near 80 at one point. Shot back up, but now on Wednesday is looking like another down day, and it's hovering near this 84 mark. If we look at time period, it could easily go up or go down from this level. This is the longer term chart. It was touching at the low 80s in mid-April. In March, it was actually in the 70s. So I wasn't thinking too much about support resistance and all that. I was just looking for the 1% return in the week. And as you can see, I thought I had a pretty good cushion on it. However, it's hovering really close to my strike price. So let's look at the actual premiums that you can receive from it. So for this one, we're right now at 84. Let's look at the 10-day. Again, it's going to be different based on the premiums received, the time value, and all that. But let's say that it ends right at 84. If I sell a covered call at 85, it's going to pay low price 400, midpoint 335, and the last trade was 435. Last trade was 449. So let's just go around the 435, making $435 in 1 week of a premium out of the 8,500 that you did. Is a 5%. So you have a 5% return for the week. Looks really good if you go to the 85. But let's say that the stock absolutely tanks and we're at, say, 75, then we'd be $10 off. We would have to look at the premium that is around 95 or so, because it'll be $10 more than the 84 that's currently. So we'll go around 94 for the next week premium. That is still paying about $100, so 100 over 85, a little over 1% premium, even if the stock or ETF goes below to 74 or so. The stock would actually have to drop to around 70 just to get less than 1% in a week. So say it's at 70 to 85, it's a $15 difference. So we'll look at 84 plus 15, around 99 or so. I need to go to almost all the strikes to see that. It's around 99. It is paying about 0.38. In that case, it's quite a bit lower than the 87. It's a little under 5%, 0.5%. In that case, 0.4%. So the stock tanks and I end up doing the 1% a week strategy. I would have to go really high on the strike price in order to make the difference of the 1%. However, if I'm going to keep it at 85, again, these are very similar returns because I don't know exactly what the premium will be. It's based on what the current share price is. I'm just trying to find the difference of the two to look for the possible premium. If we look at it any other way, to get 1%, right now at 84, to get the 1%, need about a 94 to 94.50. Actually, it's a little higher, 95 or so. It's 95, the last call is 87 in the premium. 87 divided by 85 is a little over 1%. So in that case, it would be a pretty high return. If the stock ends at 84.22 in the end of the week, going with the 1% a week strategy, you can actually sell a covered call all the way up to 95. If it happens to hit at the 95, you earned your 1% in the week premium anyway, and then you earn 85 to 95, you would earn another $1,000 in your capital gains. Finally, let's look at the last strategy of selling the covered call at a delta of 0.3. Again, as I'm doing it, it's 84.33. The delta of 0.296, pretty much 0.3, is at a strike of 91. So that's a good amount of capital gain. In this particular example, it's kind of in between the two strategies right now. But for 91, it's paying about 180 or so. 180 divided by the 85 is a 2% weekly premium return. So all of these are good possibilities, I think, especially if the ETF runs pretty much sideways or slightly up. But trying to see which one might be the best bet. And we'll actually track all three strategies here. And I'll look at the data to see what might end up being the best strategy in the end. Okay, so those are all the numbers for the three strategies. I will pick one of the three strategies and definitely follow along with my journey here to see which one I do and what happens to the numbers. But we will be tracking all three of the strategies, and I'll look at the premium received in all three. So it'll be a running tab to see which strategy happens to be better in this situation. I don't know the right answer to that. If you want to leave a comment down below, which one you think might be best, definitely put your best guess in. The best strategy in this particular situation may or may not be better in a future situation that we have. So that's why you got to be very flexible with what your trading strategies are. Again, any questions or thoughts, leave a comment down below. Smash that like button. It helps the YouTube algorithm. And like, subscribe, all that good stuff. Definitely appreciate all the support. And follow along in the future to see what happens with these strategies. Talk to you guys next time.